Hi, my name's Brian Stetina, tax partner here at Casson. Glad you were able to listen in on our webinar that we taped for you here to talk about the American Tax Relief Act of 2012. Obviously, it was something that came together really quickly. Obviously, they had a lot of time to do it, but they did it on January 1st, and it signed in on January 2nd, and we're off and running. So what I'm going to do today is talk a little bit about some of the big provisions that you're going to expect from this bill, and some other items that are affecting us in 2013. The first part of it is the individual provisions. Now, at Casson, we work with a lot of small businesses, and we work with a lot of individuals. And the small businesses, the things that are in the business provisions that we'll talk about later affect the individual, because a lot of our companies are small business entities that flow through to their personal return to pay the taxes. So let's get into the individual provisions first. The first one is individuals with taxable income greater than $400,000 and $450,000 for married filing joint. And what this is, if you're over this taxable income threshold, your highest tax rate now is going to be 39.6%. Anything over this threshold. Under those thresholds, it's the way it was previously in the last few years. So 39.6% over $400,000 for single, $450,000 married filing joint. Also, if you're over these thresholds, you're going to have 20% on capital gains and qualified dividends. And what does that mean? Well, if you sell stock that's you've owned for over a year, long-term capital gains, it used to be 15%. Well, now it's 20% for these individuals who are over these thresholds. And something I want to point out, if you have an installment sale, let's say you've entered into an installment sale a few years ago. So you sold somebody some property and they're paying you over so many years or whatnot. Whatever you receive in 2013 going forward are subject to these new rates if you fall under these thresholds. So it doesn't matter when the sale began. So basically, again, anything under these thresholds, you're at the old rates that you're accustomed to the last few years. The next thing I wanted to point out was the FICA tax withheld. So basically, employees were having 4.2% withheld from their check the last 2 years for Social Security. That's going to go back up to the original amount of 6.2% that we're used to. So just want to make sure you understand that if you get a paycheck, you're going to see a little bit less in it this year in 2013. One of the big ones was the alternative minimum tax. They made relief to this permanently. What they've been doing over the years is they've been patching AMT, and what that means is increasing the exemption to cover the increase in inflation and in people's income. So what they've done here is made that permanent. They're permanently patching AMT, which means they're going to keep the exemptions going up every year based on inflationary rates. It's also allowing some non-refundable personal credits to offset this AMT. So like a child tax credit. Used to be just be able to offset regular taxes, now offset AMT. And if they hadn't done this, over 60 million people would have been affected. People who had never been in AMT would have been in AMT in 2013. One thing to point out here is this is going to delay the filing season this year for 2013 a little bit, because the IRS is scrambling now to get the forms and then the software ready for these updated exemptions. The next one is the peace limitation. Peace limitation was came out many years ago by a congressman with the last name Peace, and he decided that basically that your itemized deductions should be limited based on if you're a higher income earner. So what this does, if your AGI is over $300,000 for joint filers, you're going to lose 3% of your itemized deductions for every dollar you're over the $300,000. So if I'm over the dollar by $1, I lose 30 cents of my itemized deduction. So forth and so on. So it goes up for every dollar. You're going to lose 30%. It caps out at they can't reduce your itemized deductions more than 80%. So you're still going to get 20% of your itemized deductions if you're really high in income. Personal exemptions are going to phase out again with same thresholds. Depending on your income level, these could phase out all the way to zero. So be aware of that if you get exemptions for children and for yourselves. The big one for me, and in my eyes, was the estate and gift tax. I really did not think this was going to stay at $5 million, but it did, and I'm glad it did. Essentially what that means is if someone passes away and they're worth less than $5 million, they don't have an estate tax requirement. If they're worth more than $5 million, they get a $5 million exemption. And also for gifting, they can give away up to $5 million in their lifetime without having any tax responsibilities. Now, it also extended the portability between spouses, and what that means is if one spouse dies and they're only worth $3 million, then they have $2 million of unused exemption that can pass over to the spouse. So now the spouse has $7 million when they pass away. But one point to point out is that the tax rates did increase to 40%. They were 35% the last 2 years. And so the $5 million exclusion is subject to inflation. So in 2013, it's actually $5,250,000 is your exemption. And also for 2013, they've extended the yearly exclusion of gifting to $14,000. It used to be $13,000. So basically what that means is I can give any one person $14,000 without any gift tax requirements. So I could give 20 people $14,000 apiece and have no gifting tax requirements. The next one's the child tax credit. This was extended. It's for $1,000 per child, which is a nice credit for people. It really provides them with a nice little tax credit. It was supposed to go down to $500. They extended it back to $1,000, and that's permanent, which is nice. Also, the earned income credit was extended. There's been some enhancements here. There were some enhancements made to this over the years to allow more people to fall into this credit. It is a refundable credit. So through 2017, they've extended the enhancements on this credit. Then there's the adoption credit. You get a tax credit for the expenses that you pay to go through the adoption process. And so it's also excluded from your income if the employer pays for some of these expenses. Child and dependent care credit amounts made permanent, so now there's a nice cap on that. There used to be a 35% rate on $6,000 of expenses, so now you can be able to take that total just as you were before. And another big one is the educational credits. The American Opportunity Tax Credit was extended through 2017. And this is for qualified and related tuition expenses for the first 4 years of the student's post-secondary education with a maximum of $2,500. And some of this can be refundable, depending on your income ranges and where you fall. And they've also extended the above-the-line tuition and fees deduction, and that basically gives you up to $4,000 of a deduction, not a tax credit, a deduction. And you can't take the deduction and the American Opportunity Credit. So it's usually the credit ends up being better, but sometimes the deduction actually does help you depending on where you are. The student loan interest deduction. Usually the way that was you could only deduct interest on student loans on your tax return for up to the first 5 years of the loan. Well, they've gotten rid of that. You can deduct it over the life of the loan now. Employer-provided educational expenses up to $5,250 can be excluded from income. Residence and mortgage. This was extended through 2013. Essentially, you can exclude cancellation of debt income on your principal residence up to $2 million, which, in the last few years, a lot of people have been foreclosed upon or had short sales, and they've had banks forgive debt. Usually that would be you would have to pick that up as taxable income. Well, up to $2 million through 2013, you can exclude it from your income on your principal residence. Some other items to point out is the conservation contributions. And what this is, especially in Delaware, a lot of times the state will come in and buy development rights from you. So if you have a bunch of land and you haven't developed on it yet, let's say you're a farmer and you're farming it, they'll come in and buy the development rights so that no one can ever build on this land ever. So they'll pay you X amount of dollars based on how much the development rights are valued, and then you get a charitable contribution for the other side because you can never develop on it. So yeah, you get some cash in your pocket, have some gains on it, but then you get a nice deduction to help offset those gains. So that was extended through 12 and 13, up to 50% of your adjusted gross income you can deduct, and 100% for farmers and ranchers. And also they've extended the RMD to charities. Basically, certain individuals have to take a required minimum distribution from their IRAs and 401ks and such. So through 2013, if you want to do your RMD up to $100,000, you can just tell them to roll it right into one of your charities. It doesn't get picked up as income, nor do you get the deduction, but it's a wash. So now we're going to get into some of the business provisions. The biggest one is the depreciation, bonus in Section 179. Bonus depreciation and Section 179 have been around for a while, and they've extended them, increased them, decreased them, and then increased them again. What that is bonus depreciation allows what they've extended is you're allowed to take up to 50% of your qualified new property through 2013. It has to be new property. It can't be used property. And qualified property is usually depreciable property that usually has a 3 to 20 year life. You can take 50% of that cost as deduction in the first year, and then the rest of it over a 5-year period or whatever, depending on the life of the asset. Now, the nice thing about that is there's no threshold, no cap on it. So if you were someone who spent $5 million on some big addition that required equipment, you would be able to deduct 50% of that. Then they've increased to Section 179. That was supposed to be a $139,000 deduction for 2012 with a $500,000 limitation, but they increased that to $500,000 deduction, retroactive 12, and for 13 with a $2 million investment. And that can be any property. That doesn't have to be new. It can be used property as well. So it's a nice deduction. 15-year property extension. What this is qualified leasehold and retail improvement and restaurant property. You can get a 15-year life on it. Let's say I own a restaurant and I build an addition on it. Well, a lot of times, a lot of that addition would be subject to 39-year rules, which means you can't take any accelerated depreciation on it. You just depreciate it over a 39-year period. Well, with this one, they allow you to reclass that as 15-year property, so therefore it falls under bonus in Section 179, which is a nice provision. Then there's the research. See some credits that got extended. The research credit, the research and development credit. This is a credit that comes to be if you spend money on research and development, and that just doesn't have to be research and development to develop a new product or something. It could be you just did something where you developed a new process for yourself, for your business. So let's say you're a manufacturer, you develop a way in your space or in your warehouse for the processes to be much more efficient, leaner or more energy efficient, and you developed it yourself. There's a nice credit out there that you could get for this. So it's something you should look into and talk to us about. I mean, we partner with AGN, which is an association of accounting firms all across the country and the world, and we partner with some folks that do this credit exclusively, and it involves engineering and some legal aspect to it, which we help. They come in and they'll look at it and they'll do it for you and get you a nice tax credit and back it up. Next credit is the work opportunity credit. The work opportunity tax credit is if you hire convicted felons is one demographic who are looking for a job. Veterans from armed forces who are trying to find a job. You can get a really nice credit, up to $9,600 per person in the first year. So it's something you want to talk to HR about and talk to your payroll company about. Make sure they're filing appropriate paperwork and asking the appropriate questions when you're hiring individuals. And there was some energy credits that got extended, basically the $500 lifetime credit on improvements to your home. Like if you put in energy efficient windows, you could take a $500 credit. Now that's a lifetime credit, so if you've taken this before, you can't take it now. And then there's been several fuel tax credits that for businesses that have been extended. One that comes to mind is if you, let's say you have forklifts in your warehouse and you run those forklifts on propane. Well, the propane in those that run those forklifts are eligible for a 50-cent per gallon credit. So if you bought 10,000 gallons of propane for your forklifts, you would get a $5,000 tax credit. It's a nice credit. And some other things I want to talk about are some new taxes that came from the health care bill. This doesn't have to do with the American Tax Credit Act, but it also has to. These things are new for 2013. The first one is the 0.9% on earned income tax. And what this is if you're over $250,000 of adjusted gross income and you have earned income over those thresholds, so for wages or self-employed income, if you're a Schedule C or if you have LLCs, trade or business that flow through, you're going to pay an additional 0.9% on the amounts that are over and above these thresholds. So something to think about. Earned income, it's important. Now, the 3.8% Medicare tax on unearned income. Now, this is a 3.8% tax on the lesser of your net investment income or the amount that you exceed the thresholds. The thresholds are $250,000 for married filing joint and $200,000 for single. So if I'm over the $250,000, now I have to make this calculation. So let's say, for example, I'm $300,000. I'm $50,000 over the $250,000. I've got to pay 3.8% tax on the lesser of my amount over the $250,000 or my net investment income. So let's say over the $300,000, I have $20,000 of net investment income, which would be interest, dividends, capital gains, income from rents, passive activities, royalties, things of that nature. I'm going to pay 3.8% on the $20,000 because it's the lesser of the amount over. So let's say I was $500,000 and I had no investment income. It was just a wage or a W-2. I wouldn't pay this 3.8% tax. So it's a big-time tax for certain individuals. And some additional changes this year that you got to be aware of, especially as employers, is the flexible spending accounts. Employees can only put up to $2,500 pre-tax in their flexible spending account for medical expenses. Now, there's no cap on that for dependent care, but for medical, it's $2,500. And then for medical expense deductions, if you're someone who itemizes your deductions and you usually take medical expenses and you fall under those caps, it goes from 7.5% of adjusted gross income to 10% for going forward. Now, if you're 65 or over, that doesn't change until 2017. So I've already talked about the temporary payroll tax cuts. I won't touch on that again, but that's it for today. I just wanted to point some of this stuff out to you here at Fall Casson, and make sure you're aware of what's going on and you can hear it from our lips. And if you have any questions, give us a buzz. Give me a call. I'd be happy to help you out, see how we can work around this, plan around this, and do what's best for you. So I thank you if you've listened in, and we appreciate your time.